there's someone who said they don't work with financial planners or advisors because they don't want someone who's broke telling them how to manage their money.
I've had a doctor that smoked. Financial advisors are not trying to be rich as such. And if they are trying to be rich, they are not trying to get rich quickly. You don't have to be super wealthy to have a work. That when someone dies, everybody jumps in. This was my brother's car, this was my brother's house. You know, there's my brother's money and all that type of thing, because people have not set certain parameters. So if you
Welcome to another edition of Mindset Profits. We're getting you off to a strong start to the year, and I want to have that conversation with the financial advisor you should have been having. I am bringing back Joe Nketane. Welcome, Joe.
Thank you.
And whenever I'm around you and I see you here, I know we are doing damage to financial ignorance.
Oh no, absolutely.
You're the man.
What a beautiful expression, the last guest we had on radio. I've never someone put a concept like that, but yeah, it was quite interesting.
Mismanaging financial ignorance and doing damage to financial ignorance.
What a tongue twister, eh? Reverse thinking type of thing.
So a lot of content creators now have to say, this is not financial advice. I'm not a financial advisor. So I try now to get away from that disclaimer and just bring a financial advisor.
No, absolutely.
Why do you guys love those disclaimers?
Look, I think it's just being very careful that whatever you say out there, you could be sued unnecessarily. You know what I mean? So what you try and do is to give guidelines to what people should be doing. You know what I mean? So to give proper advice, you should have all the necessary facts that you need in order to advise someone. You cannot advise just out of the blue or out of casual talk. You know, you need to have the facts to render the advice.
All right. So the disclaimer is because people's financial circumstances are unique.
Absolutely.
And any piece of advice we give going out there is going to land and work differently for different people in different situations.
Absolutely. That's why this is not advice at all. It's just
also another disclaimer.
Exactly. It will just be a chat.
All right. So beautiful. But Joe, I made it a mission for people or to challenge people to have the biggest year of their lives.
Yeah.
Not many people think in that frame of mind.
Yeah.
And I want this to be a cool challenge in that direction. But when I talk to you, I know we're talking a lot of protect the money that you are building, this wealth that you're building. Yeah. When it comes to having conversations with financial advisors, why do you think it's not a priority for many people?
Yeah, I think in general, people think it's a conversation that is unnecessary. A conversation that should be delayed for tomorrow, a conversation that really doesn't affect their lives that much. You know what I mean? It's just one of those inconvenient conversations if they were to come up. You know what I mean? That's basically it. People know it is important, but hey, can we delay it a little bit? Can we see it another day? You know what I mean? But deep down, people know that they do need to have those conversations, but because eventually they may result in purchasing a product, things like life cover. You know what I mean? It's a purchase at the end of the day after having a full financial needs analysis. You know, and therefore that purchase is not going to be like when you buy say groceries or you buy a pair of pants. This is more of a grudge purchase because people buy it. Why should I buy life assurance? I may not die and I'll be paying premiums for the next 30 years or 40 years and my money is not going to come back. You know what I mean? But they know that they may die within a year or two. They need to buy. So when they buy, it's generally a grudge purchase.
It's a grudge purchase.
It is.
At what age normally do people start coming from experience?
Yeah.
Coming to you to have the conversation with the financial? Do most people start in their 30s? Or you're starting to see a shift?
No, absolutely. I don't see much of a shift. It's more, your late 20s early 30s. And I think it's when people are now gainfully employed, if they were students, and now they've got permanent jobs and things like that, and they're starting families. That's where those conversations start. But anything earlier than that, guy is just graduated, and all he wants is more like savings to make a huge purchase of something. It's either a car
So people
or
come
a
to
house
you
or
and
anything like that.
when there's something they want to buy.
That they want to save for. You know what I mean?
Okay.
Yeah. So a young guy that is just graduated and all that, he's wondering when he'll get his next car. What does he need? Does he need to save for a deposit or anything like that? You know, that's when those conversations start. But more deeper conversations start when people start having families, and that's where we go to the deeper stuff. But much younger, it's more about savings.
So let's pick the conversation from families.
Yep.
There's something you highlighted earlier, wills and estates. Where's a good place to start? Wills and estates or the financial plan for families?
I think the financial plan is the more poignant conversation to have.
Yeah.
And I think estate planning, which involves a will and trust and all that, will be part of that conversation. But the first thing to establish are what the needs are. The needs will determine what the solutions are. So financial advisors have changed. Many years ago, we used to sell products. But now it's no longer about product selling. Now it's about advice. You know what I mean? What we do, we gather information about your circumstances, how much you earn, how educated you are, what is your lifestyle, are you married or not, do you have children or not, the lifestyle that you've built around yourself, future plans and goals that you want to put in place. You know what I mean? So that's where the financial planning comes in. We're not speaking of any product at all at this stage. We might not even speak about a product. It's about the planning. And this is collecting data from the client or potential client. And after collecting the data, that's when we're going to speak about what would be a solution in their circumstance should we pick up problems or shortfalls in their planning.
What differences do you see between someone who says, I can do this on my own, like invest in stocks and shares, go to easy equities and do that on my own? I don't know. I can do this on my own versus do I need to have the conversation with a financial advisor? What is the difference that I'll see?
Yeah, I get you. I think with investments, it's much more easier. I think the world has evolved so much that there is technology that can actually assist you in investments. You know what I mean? There's cryptocurrencies, there's easy equities that we're speaking about, there's ETFs and all that type of thing. Some of these things you don't need to be a specialist in order to invest in. I mean, as long as you've got a computer and you can read and write, you can find your way around it. You know what I mean? But I think using a financial advisor or planner somehow helps in streamlining what you want in line with your goals. You know what I mean? Yeah, because you just don't want to invest aimlessly. You know what I mean? What are we investing towards? What is the end goal? So having a financial advisor or planner to partner with can assist you in guiding that. But yeah, when it comes to investments, it's very easy to do it on your own. But a financial planner helps in putting a plan together.
All right, you keep saying we will run the numbers when when we're having a conversation with the financial planner.
Yeah.
What kind of numbers are we running?
Okay, so when it comes to risk planning, that's where we talk numbers the most. Because with investments, it's simply, I want to save 10,000 rands a month, and in 5 years' time, I'm hoping it's going to be X much. And end of the story. You know what I mean? Then we can speak about how much risk you want to take. Are you a conservative investor? Are you a moderate risk taker? Are you an aggressive investor? In that case,
investment.
Exactly, investments. Then we can say, this is the way to go if you fall in one of these categories. But when it comes to risk, Risk is where a man and a woman come to me, husband and wife, and they say, we're married, we've got 2 children, and we want to make sure that as we live, and if anything happens to any of us, the surviving spouse is okay financially. They don't take a strain because the one income shall have fallen off.
Okay.
Or if we die together, our children are still well taken care of. The standard of living that we've set will still be maintained. Then it's very difficult for an untrained individual without the necessary tools to help themselves. That's when we talk about numbers, where a financial planner shall have gathered all the information, all the data that they need about this couple, and then thereafter do calculations and suggest to them or advise them to say, this is the amount of cover that you need, and this is how it's going to work. Mm-hmm. So in general, if you wanted to maintain your standard of living, depending on how much you're earning, okay, we'll do a calculation that will say, if Mr. X dies and he was bringing 100,000 rands home on a monthly basis, the amount of life assurance he's supposed to get will ensure that there is 100,000 rands coming to the family until the youngest kid turns 24. So, of course, we do need a bit of calculations in that, because that 100,000 rands, I don't know what it does, pays...
So you look at the income that's coming, you look at all the things that I'm currently paying.
Exactly, that 100,000 covers,
And if it's supposed to cover my kids, in future, if something happens to me, you're looking at how old each of them are.
Exactly, yeah. So what you're doing with your 100,000 rands, for example, let's take for granted that it's only the husband that is working.
Yeah.
Okay. There is a bond to be paid. There is groceries to be bought. There is your utilities, your municipal bill, your water, electricity. Maybe there is a domestic help in the house. There is a vehicle.
Yeah.
There is medical aid. There are school fees. So all those things somehow need to continue to be provided for.
If something happens to
the breadwinner.
Yeah.
All right. In that case, that's when we need to establish what all those expenses are, and therefore come to a figure or a number where we say, Meneer, you need to be covered for this much. This will make sure that your family's provision remains as it is right now, as if you did not die. Okay. So your youngest son or little girl that is 2 years old will not experience any difficulty that you are no longer around. You will make enough provision that by the time they turn 25 or 24, whatever age,
by the time they
finish,
get independent.
exactly that, they've completed their tertiary training, they would have done that smoothly with your provision, although you would be providing from...
I get you. Why do you have a show like I Blew It then? Because that structure sounds foolproof. But when I watch that show, it's like someone passes away, a huge lump sum gets paid to this guy or girl, and then they go crazy.
No, absolutely. Yeah, I blew it. Well, I see a lot of I blew it when it comes to lump sums. You find a 27-year-old that possibly has never worked in his life, or if they worked, they didn't earn as much money. And all of a sudden, they're involved in a car accident, and the road accident fund pays them out. And all of a sudden, they've got 8 million rand in their pocket, and they go haywire because they've never seen such, and there is no concept what to do with it. You know what I mean?
Yeah.
In that case, they need to be set down with a financial planner, and they help them to stretch that money, till,
I get, Brajo, the one that gets accident lotto, those random money that comes.
True.
Where I'm coming from is the financial plan with respect to inheritance.
Yeah, absolutely.
Because there are some that go crazy, and the money they get is from inheritance.
Yeah.
What structure needs to be there to make sure that the child doesn't get a lump sum and go crazy.
Yeah.
How do you protect the family from
So
something like that?
it's a great question. It's a great question because the guy that got money from the road accident fund, together with the guy that gets an inheritance from a deceased parent, they can go the same route. They both can go wild. It just depends. The difference is that rough, you get cash, but with this one, you can get cash as well, but it can be managed that it just doesn't become raw cash. What a parent would do, they would set up a will where you say, if I were to die, I want my estate to be divided in this way. Okay? And you can always update a will as you carry on. You know your 3 children, you know how responsible they are, and maybe there's this one who's not as responsible as the others, and you want to make sure that you put measures in place that if they get the money, they don't blow it. You know what I mean?
Yeah.
You are able to put measures in place where you say in your will, this son should not get, a lump sum of R1 million as such. Let's give this boy R1 million in drips and drabs, in tranches, or maybe, in installments, if I can use that term loosely.
Yeah.
This is to save him from blowing that money. You know what I mean?
Well, so the protection against that happens in the will.
Yes, exactly that. You can form a will. You can in a will nominate or form a trust, which is called a testamentary trust. Okay. So that normally happens between when your children are young up to a certain age. You can choose age 20, 25, or anything like that, And at that time, your children are protected by the stipulations in the trust. But once a trust is terminated and you say at 25 you can release funds, it could be a time where, this boy takes this money and blows it. But of course, you are able, as you live with them, you can see if there are dangers or red flags around this one child. You can say, he's not getting any money until he's 40, He'll get just enough to keep him alive up to a certain age, and possibly at that age he shall have matured. But how long do you protect an individual? You know what I mean?
Against themselves.
Yeah, if they are irresponsible up to the age of 40, 45, surely there's very little you can do. You know what I mean? But there are measures to protect or to prevent the I blew it situation. They may blow it bit by bit. If they're getting 20,000 rands a month, they can blow that 20,000 rand, but they are not going to be thrown out in the streets because you shall have secured possibly a house for them. So there are those measures other than, if they got money from the road accident fund as such. So you can put in place a protective measure, which is a will, and you can put conditions to it as well. I know some people will say, my son or my daughter, you are going to get this lump sum, provided you've got a degree, and I've provided the money for you to go to varsity. And after getting your degree, you must have kept a job for 3 years. Then thereafter, we'll pay you the lump sum, So the trustees will ensure that happens. So there is protection that can be provided.
Also, some parents go that far.
Oh, yes, absolutely.
I'm thinking, though, isn't it a parent who's given up on the child? Because a safer way to prevent this would be to train the child on how to manage money.
Look, I think it's
you
easier
only
said
go
than
to
done.
these measures
Yeah.
if you
It's
see
only-
that
yes,
this is not working.
Yes, absolutely. It's easier said than done. You know what I mean? That we train our children, we expose them to money. But we all have different many personalities. You know what I mean? And maybe the way you know me, if you haven't put cash in my hands. The minute you put cash in my hands, boy oh boy, we see a totally different individual. You know what I mean? So I think it's safer for a parent to put certain mechanisms. If it happens that the children are responsible and all that, great, it's a win-win. But if they happen not to be that responsible, at least they have protected them up to a certain time, But of course, we should be mindful of not trying to rule from the grave. You know what I mean? And saying,
Not
okay,
trying to?
to rule from the grave. It's like saying, okay, Ndando,
Yeah.
I pass this money on to you. But you must make sure that you use this money in this fashion, and this fashion, and this fashion. And after you've given it to so and so must do ABC with it. You know what I mean? So it can go up to eternity. So that's ruling from the grave. I think what you need to do is to give certain parameters, and you can only go that far. It cannot go further than that. You know what I mean? You are not there, make peace that you're not on earth anymore, and you've left the money. Yeah, trust the processes that you've put in place, that they will go to a certain extent to protect that inheritance.
If I come to you and I know that I'm irresponsible, I've been irresponsible with money, where do you take the conversation? If you see, and I'm confessing that I
Okay.
haven't been good at handling
Yes.
my money,
Yeah.
but I'm coming to you because I feel like you will help me.
Yeah.
Where does the conversation go?
Look, if you came with a lump sum and you want this lump sum to last, and you want to protect it against
Myself.
yourself, there are types of investments that we can put in place where we can invest the money for a certain duration, where the money is not easily accessible for a certain period. But of course, we shall allow you a certain amount on a monthly basis. You know, like each and every month you'll get X amount. Then at the end of a period, say 5 years, for example, you'll get your capital back. You know, and of course we'll reinvest the funds at that stage. So at least for 5 years, we know that you can blow the income that you're getting as much as you can, but the following month you are guaranteed of the same income. This will carry on for 60 months or 5 years. After that, of course, we relook at how things
All right,
are.
so I'm looking at two things. As a financial planner, you can help me with a system that protects my money from me.
Yep.
You can structure a system there, which helps. I'm also looking at the other side, though. Do financial planners have a way to train me as well? Like coach me
Yeah.
out of the financial behavior? Because
No,
as
absolutely.
long as I keep it, I'll
Yeah.
keep scheming on ways to find access to that money.
Absolutely. It's our mission to do that.
Yeah.
It's our mission to do that, this is our livelihood, and we want to keep our livelihood for as long as we can. So if we can keep a client close by and we can train them in one way or another, obviously the relationship will improve. They are likely to stay with us, and they are likely to refer us. So it is in our best interest that we keep the client as close as possible and for as long as possible. So of course we'll be trying to train them that the money doesn't run out, because if the money runs out, I have no business as well. You know, so it is in my best interest that their client gets to keep their money and grow it, because it's a mutualistic type of
I get you.
relationship.
How do I know the difference then between a good advisor or a bad advisor? How do I find the right one? Because someone can listen and enjoy the conversation with you and say, I would work with Brajo.
Yeah.
But how will I know if I can't access Brajo for whatever reason? Maybe I'm too far or whatever reason. How will I know that I'm talking to a good and a bad? Every industry has got good
absolutely.
and bad.
Yeah.
How can I tell the
So
difference?
are you trying to get me to bash my colleagues?
There's no one in mind. So,
No, absolutely no.
but I am trying to protect the community to say, if you're going to go this route, look out for 1, 2, 3.
Yeah, no, absolutely. I think one of the most important things to look is to look at their track record. You know, how long they've been in the industry. It's one of the pointers as to whether we could trust this individual or not. Are they going to do a hit and run and you never see them again or anything like that? Qualifications also matter. you know, whether they are in public platforms like your LinkedIn, you know, business platforms, your LinkedIn or anything like that. The company that they may be working for, it's a solid, reputable company. Surely that company will not be wanting to hire cowboys, you know what I mean? So they want to keep their good reputation and they train their advisors well. So those three factors.
You
would
mentioned
count.
qualifications.
Yes.
How will I check those? Do I ask? Because there's
You
a
may
possibility
ask-
they might lie.
You may ask. You may check them on LinkedIn if they are there. But of course, their business card as well can say if they choose to put their qualifications there. So, but yeah, with the advent of technology, it's easy to pick these things up if you're really looking for the information. You know what I
Okay.
mean? Yes. So, yeah, I think those three factors are
right, so-
helpful in deciding that.
That's more validating that I can work with this one.
Yeah.
What about the next phase that when they are talking to me, I can tell that they've got good intentions, they know what they're doing, and they can help me?
Look, I think it also depends on the chemistry. You know,
Yeah.
It's important that you have chemistry with your advisor. This guy can be as solid can be, but in certain cases you don't connect. You know what I mean? And if you don't connect, then trust becomes
problem.
an issue, and therefore you may not take some of the advice as genuinely as they dish it out. You know what I mean? Because you don't trust them because there is no chemistry. I think the one important thing is to gauge if you bond well with this individual. It's same as us advisors. I want to work with someone that I have some kind of chemistry with. You know, the clients you speak with, and you're seeing red lights all the way. And there is nothing that a financial planner fears more than a customer complaint. You know what I mean? When someone complains about wrong information given, that they were dishonest in one way or another, it's the biggest blow that a planner may have. So even to financial advisors or planners out there, if you feel that there isn't much chemistry with this person, you're battling with understanding each other, there are certain nuances and innuendos, and maybe there's a language barrier and things. My advice is, hey, bro, walk away. Walk away if you feel that you're not bonding that well. There isn't enough chemistry. Walk away, because it could be problematic in the future.
I suggest that people check out 2 or 3 financial advisors and just see, because when it's your first time doing it, you'll never really know that I spoke to the right one.
Yeah, look, it will be very different to tell one to the other, unless, you know, they're giving extreme diverse information. You know what I mean? But if you went there with the same type of scenario, the solutions that you hear are suggested by the 3 different planners should not be that diverse from each other.
Okay.
Unless someone goes totally on a different route, that person could be maybe the best or the worst, you know? But I think, generally speaking, you should be getting information that is similar. And of course, the guy that you have better chemistry with is the one you're likely to go with.
What's your take on this statement? I know it's controversial and you don't like bashing on your peers.
Sure.
There's someone who said they don't work with financial planners or advisors because they don't want someone who's broke telling them how to manage their money. Meaning, I make millions, the financial planner doesn't. Why am I having the conversation with them?
Okay.
I know there are many advisors that make the millions, but still, I think you get where I'm coming from.
Yeah, I get it.
That there's a whole lot of clients or potential clients that make so much more money than the advisor.
Yeah.
And they battle with the fact that why should I have the conversation with someone? I need to be advising the advisor to get to my level.
I get it. I've had a doctor that smoked. And he was my doctor for the longest of time. You know what I mean? And whenever I went to him, whatever problems I had, he was able to solve. So it's the same thing. Financial advisors are not trying to be rich as such. And if they are trying to be rich, they are not trying to get rich quickly. You know what I mean? I think if you run your financial advisory practice well, honestly, diligently, with consistency, and with ethics and truthfulness, over the long term, you will do well. Unless, of course, you want to be rich quickly, that's when you're going to cut corners and you're going to give wrong advice, and we definitely are going to see you in one of these commissions that are happening. You know what I mean? But, of course, we cannot help it that some clients are wealthier than we are. But they may be wealthy, but they may not be knowing the structures that are in place to help them in terms of tax, estate planning, and all that. Yes, they have made money in manufacturing. You know what I mean? And it's good. They're rich from that. But manufacturing and financial planning are two different things. So I'll help them with their financial planning as good, and of course they'll continue with their manufacturing skills. So that's the difference, yeah.
Right, to kind of get you. Let's talk about wills and estates. You mentioned a case that has been, I don't know if it's trending or not.
Yeah, absolutely. I can speak about it. It's in the public space, nothing to hide there. You know what I mean? That a will is one important thing to put in place. And you don't have to be super wealthy to have a will. I mean, as long as you are gainfully employed and you are picking up assets, you know, it could be property, it could be, gold coins, it could be anything of value that you'd like to leave behind for someone. You should be having a will, because these problems generally, whenever there is no will, we see it a lot in our demographic, that when someone dies, everybody jumps in. This was my brother's car, this was my brother's house, you know, there's my brother's money and all that type of thing, because people have not set certain parameters. So if you set those parameters, you're actually dictating to the world to say, what do you want to happen to your estate, you know? But if there is no will, a lot of things can go wrong. So, yes, and it is important that it is done through the right institutions. You can buy a template of a will from any stationery shop. You know what I mean? And you write your will. As to whether it will be enforceable and whether it's a valid will at the time when it's going to be executed, it's something else, you know? So I would say anyone that wants to draw a will, go to a reputable company, an attorney, a bank or insurance company, and have it drawn there. You know, they will show you things that you do not know. For example, there is what we call estate costs. When you die, there are certain taxes that you may have to pay as well, estate duty, you know? So if you are to do a will yourself, you don't know what the executor is going to be experiencing as he winds up your estate. You might find that your estate is so large, it's about 3.5 million rand, and that is estate dutiable. So you may have to pay those taxes. So if you haven't made provision
for the taxes,
for that, which can result in to figures of 800,000 rands, at times 2 million rand in taxes that you might have to pay. So if you have just drawn your will from a template, you might not have made provision for that, and the executor might have to sell certain assets in order to settle those taxes. So it is important.
Then affects who you say, I want this one to get this house, this one to get that car.
Exactly that, yeah. Because creditors will take preference. And of course, SARS
comes first.
Exactly. You'll come first. You know what I mean? So if you have done it through a financial planner, you are better off. You know, all those little loopholes are actually closed. There are certain policies that are sold that is to take care of those estate costs. If we know that we've done a calculation that you will need to pay 1 million rands in taxes at death, we can put up a small little policy where you'll be paying 200 rands or 250 on a monthly basis, This is to make sure that when that time comes, that policy pays out and it pays off the
So
estate
that's
costs.
part of the structure that you would have
Exactly.
set up in advance.
Exactly.
You estimate how much taxes
Exactly.
the estate is
Exactly.
going to be paying,
Exactly.
and there's a premium that I'm
Exactly.
paying
Exactly.
towards the taxes.
Yeah. So it's a smaller price to pay compared to having to sell a property or a vehicle in order to settle estate costs or estate.
What
duty.
happened in the case? What went wrong?
What's happening? Nothing has gone wrong yet. But what is happening is, I think we need clarity with certain things. Wills can always be contested. In many cases, someone will say the will has been forged. I've seen a whole lot of that where someone is not happy, generally a beneficiary or someone that expected to be a beneficiary. They will contest a will, suggesting that it's been forged, or they may suggest that the testator, that is the person that draws the will, if they're a female, they call it testatrix. Okay. Yeah. So they may say the testator or testatrix has been unduly influenced by someone. You know. So in this case, the late partner of Prof. Tuli Madonsela passed away in 2020. Around 2020, the gentleman had drawn up a will, and she was going to get 10 million rand. Okay, and maybe in other assets, I'm not too sure, but 10 million rand, I'm quite certain. And the gentleman has four or so
kids,
adult children. Okay, and he's allocated amounts to them as well. So the gentleman has passed away now, and the will has changed. The good professor is no longer getting that 10 million rands, but a house in Cape Town. But the children are now inheriting the bulk that she was going to inherit. So she's gone to court to say something is wrong here. The will has been changed. So it's either someone altered the will, and therefore handwriting experts are busy with it forensically to see if there's been some unscrupulous behavior, or the gentleman, when he altered his will, if there hasn't been any forgery, has been unduly influenced because he's probably he was unwell at the time when he changed the will. So those are the questions that are looked at as to whether someone doctored signatures or anything like that and changed the will, or was he of a sober mind to actually draw a will at the time that he did. So it will depend then as to what the outcome will be. If it is found that there was no foul play at all, the good professor will have to settle for
whatever is there.
Whatever is there, and the children will get the bulk. But the opposite is true as well. So we'll wait and see. So it is important that you set up a will, and if you can avoid any controversy around it, and do let someone know that there is a will, because these funds that are sitting with certain companies and pension funds as well, where they are unclaimed, because no family member knew that
there's a will,
and
or
there's a pension fund, or there's that out there. So it is important to speak.
There are people who died and their pension is unclaimed.
Absolutely, yes. Companies will send tracers to try and find someone. Someone came and worked in Johannesburg, and they left and they passed away in Limpopo somewhere and all that, and maybe there was a surplus in their pension fund, and they're looking for him to pay him. So if they can't find him, of course the money will sit there in unclaimed benefits.
Do you know how much money we are talking about?
There's a lot. There's a lot. There is a lot. There is a lot of money with different banks and different insurance companies. There are those funds, but there are.
If I want to go check if I have a relative there,
Yeah, look, you could try. You could try. Yeah, I don't know if you'll succeed, but you could try that. It's all worth a try. Hey?
And go with some DNAs. I know this Masego.
No, exactly. No, do try. Yeah, so there is that. People do not speak up. I mean, find someone that you trust well in the family. Tell them that you've got a will, you've drawn it with ABC company, or my financial planner or advisor is so and so. If anything happens to me, here is his business card. Go find him, and he knows, you know where to find what and how to assist you. You know.
Is there an instance where I can die and the financial planner doesn't know that I'm gone?
Yeah, no, it does happen. Yeah, no, it does happen. The aim is to keep in touch with your clients on a yearly basis. You know, we're supposed to touch base with them, do a review with them on a yearly basis. You know what I mean? So it does happen in certain cases that the client base grows so much that you're struggling to keep up with it. But you should be trying to keep in touch with the clients, see them at least once a year, speak to them via email. Right now, I think things are easier that we can do this virtually.
Calls.
Yes, but the aim is to try and get hold of your clients every year to do a review. Has your financial status changed? Are things the way you want them to be? Can we change something? Can we introduce something to you that you don't have? That type of thing. You need to keep this ongoing relationship. The days of hit and run are over. We should be looking after our clients because they pay us fees as well. So we should be looking after them. So yeah, it may happen for some reason that someone passes away, and you try and phone them, you can't get hold of them, you send an email, bounces back, and all that type of thing. At times, you get stuck. You just never know where to find them. So I have seen it happens.
So it becomes a situation where because the person changed their number and not accessible on email, you still have their profile.
Exactly.
And they're still contributing.
Yeah, maybe they've gone and lived in another country, or maybe they're not even contributing. It was a lump sum that they invested. You know what I mean? And of course, you try and reach out to them so that you can do a review with them, but you can't get them at all.
These becomes all the unclaimed money.
No,
so
exactly.
It's possible to write a will, forget to update it, and then I've got all these other assets that no one knows about.
No, exactly. Yeah, you may have an investment with a particular company, and you go visit Australia or Greece, and you pass away whilst there, and possibly you didn't have anyone in South Africa. And of course, your money is here, but we can't get hold of you. You know, so I've seen it. It happens. So it is important that whatever business you have with any company, with any financial planner, do let someone know that you've got this. You know, and.
But Joe, how do you protect your kids against your relatives? I'll give you context.
Yeah.
There's a lady that's she is angry at her relatives because when the parents passed away, they left some money. The kids were supposed to stay with this person. This person got access to the funds, wiped the funds away, and then when they grew older, they start to realize, I think there were two kids. You'll explain, I think you'll understand it better than me. I'll just tell you what I remember.
Sure.
Two kids, one is 18, got older, and the other one, they're getting closer to 18. That's when they realize that there's money that gets paid out when we get to 18. But we've suffered all these years.
Yeah. Okay.
And now they're reaching out to us to sign something.
Yeah.
Because what she could remember was we signed somewhere. They stayed with us. Life never changed for us. We were struggling. But now when they were supposed to sign for the next one, that's when she read and realized there's a payout here. Then she asked herself, what happened to the payout when it was my turn? Went to go and check and realized a couple of millions were paid out. They got nothing.
Sure. That's a very sad set of circumstances. In many cases, if someone passes away and they've had some kind of benefit with their employer, either a pension fund, a group scheme, or anything like that, normally there would be beneficiaries that are nominated, and one is naturally likely to nominate their children. But if the children are minors, we cannot give them cash. You know what I mean? And therefore, funds are generally invested, and there would be someone, a guardian, that will actually look after the children's money in a way. You know what I mean? Some will pay out, and we get the money invested. But that parent has signing powers, that guardian has signing powers. So if they are an unscrupulous individual, something can go wrong there. I do have clients who their daughter has passed away, and she's left some money, and the grandmother invested their funds. And from time to time, we'll meet on a yearly basis to say, hey, it's time for school fees. Can I draw so much? So that, we pay school fees a year in advance.
Yeah.
So if you get a person that is dodgy, they are likely to do something wrong there. But of course, you as the advisor, surely it is in their best interest as well. It's in those children's best interest as well that you keep an open eye. Do ask the relevant questions if you see there's something dodgy. But at the end of the day, if someone wants to be dodgy around that area, if they want to misuse those funds, they can. It's unfortunate. It does happen. But of course, if you have set up a will, you will have a guardian that you shall have nominated, and there are trustees that will help in looking after those funds. But at the end of the day is if the children have to be paid out at age 20 or 21 or whatever, on a monthly basis, the trustees will release a certain amount for monthly expenses. It could be groceries, it could be whatever the children need, This will happen on a monthly basis. So if the guardian is dodgy, maybe they'll help themselves to that monthly payment. But of course...
But it seems in this instance, the guardian got access to the payout.
Look, it is possible. I've dealt with cases where the money is in the guardian's name. You know what I mean? And of course, if they really want to be unscrupulous, they will do. They will. And there's very little protection as such. Unless, of course, there's been a will that has been put in place and the money goes to the executor, and the executor looks after it. The guardian just gets a monthly income from that. So I think each and every case will have to be looked at in this case, because you do get a lot of talks in the corridor about a guardian that has misspent or embezzled funds, zabantwana and things like that. It does happen. But in certain cases, you don't get facts as they are. You know what I mean? Yeah. Just as much as you will hear people saying, no, insurance companies are crooks. If you die, they don't pay out. Or so-and-so died and they didn't pay out, whatever. Without knowing all the facts, you may find that justifiably the insurance company didn't have to pay. They're under no obligation to pay. But speaking in the corridors, it's very
anyone
easy to
can say anything.
These people don't pay. You're wasting your money by paying. So I think there is always a loophole that someone can use.
So it benefits me to work with a financial planner who will check on the kids, or a reputable company that will have systems for following up on how the money is being used.
Absolutely. I mean, the cases that or the instances that I'm talking about, I have a relationship with a guardian. I know that they are representing a little girl that is 8 or 9 years of age, and whenever we speak, it's like, I need so much to pay A, B, C, D on behalf of the child. You know what I mean? And of course, you will release it for those reasons. But of course, they can lie as well and say something else. And that's when you call them to order. They may be angry with you. They may walk away and be unhappy with you. That can also happen. So you are limited. You can only do so much. I'll give you an example about a gentleman who made a lot of money in the 80s.
Yeah.
I think it sued Transnet and they paid him something like 70 million or something like that. And he was rolling. It was all in the public space. At some stage he ran out of money. So one of my colleagues was his financial planner.
He
you know?
lost 70 million.
Something like
back
that.
then.
Yeah, way back then. At some stage, there were 2 Lamborghinis, yellow ones. I think you know the story. So, yeah, but eventually the money ran out. It was invested with my colleague. And I go to my colleague and say, but what happened here? You are the advisor here. How does your client run out of money? You know what I mean?
Yeah.
And he says, but it's his money at the end of the day. I'm only entrusted to look after it. If he comes and he says, I want my money, who am I to refuse him? You know what I mean? So that's basically what happens. Like you going to a doctor and he says, take these antibiotics for the
And you
next
say,
5
I
days.
don't like the taste.
Yeah, you don't like the taste. And you don't take them. You know what I mean? We can't blame the doctor. You know what I mean? So, yeah, in that case, we may say whatever we say to the clients, but it will depend on them if they'll respond in the way in which we advise them to.
Do you have any last words for someone still on the fence about working with a financial advisor?
Yeah. Guys, there are certain things that you can do for yourself. If you want to put money in a 7-day call account or a fixed deposit or anything like that for the next 12 months, please do go ahead. It's not complicated. You can do that. But there are things about legacy planning. There are things about planning your children's future. You are 35 years old, you've got 2 little children, and you want to plan their future. You want to make sure that if you become disabled, if you become sick with a dreaded disease, cancer, heart attack, or stroke, there is enough money to take care of them up to when they are financially independent. Not forgetting as well that at some stage you may retire if you live long enough. At some stage you will need that money, you know. It is very difficult to decide for yourself, thumb sucking to say, I need to invest this much in order to
live
comfortable at retirement. You know what I mean? That's where you need a planner that will sit with you, look at what your plans are. Are you planning to visit overseas 2 or 3 times a year on retirement? Are you planning on a new car every 4 years or every 5 years? What are your plans at retirement? How much are you wanting to earn? So you cannot suck thumb for those figures. You need a planner to sit with you and show you the necessary figures as to how to achieve your dreams. So do speak to your financial planner. They have your best interest at heart, and you shall not go wrong.
I think when you come back, we'll do a proper deep dive into wills and estates, because I have so many questions running through my head.
Oh, yeah?
I'll drop one now so you can think of what happens if I nominate a beneficiary and they die and I don't update the will.
And then you nominate another one.
No.
Mm-hmm.
I don't update the will.
Okay.
And then I pass on.
Oh,
And then
okay.
the will says 2 million is supposed to go to this one, but that one is gone as well.
Yeah, very, very interesting. Now, look, it can be sorted out. Okay. Let's say that person was a 30-year-old with a child, for example. So that inheritance will go to their child.
Automatically.
Yes, it will.
Even
will go
if that person doesn't have a will of their own.
Exactly, yeah. So if my beneficiary dies, the closest relative of that
person.
beneficiary is likely to enjoy the benefit. If it
Okay.
happens that you do not have any children of your own when you pass away, we'll look at your parents first. Okay, if the parents are non-existent, we'll look at your siblings. If you don't have siblings anymore, we'll look at your cousins, you know. So the closest blood relative is the one that's going to do it. But it's a beautiful subject we can tackle next
Yeah,
time.
we'll do a deep dive into it. As you are doing the transitions, my questions are increasing.
Oh, yeah. Absolutely. No, it's beautiful.
But thank you very much, Joe. I look forward to the part 2, actually. And thank you for joining us till this time. See you in the next episode. Drop any questions that you will have for that part 2, and we'll do the deep dive. Thank you.